How to calculate debt-to-equity ratio. Have you ever wondered how investors assess a company's financial health? One key metric they use is the debt-to-equity ratio. This ratio helps traders understand how much a company relies on debt compared to its own equity. Let's break down how to calculate this important figure and why it matters in options trading and stock analysis. First, what exactly is the debt-to-equity ratio? It answers the question, for each dollar of equity, how much debt does the company have? To find this ratio, you will divide the total liabilities by the total shareholder equity. Now, let's go through the steps to calculate it. Start by identifying the total liabilities of the company. This includes short-term obligations like accounts payable and taxes owed, as well as long-term debts such as mortgages and bonds. Next, determine the total shareholder equity. This figure includes common stock, preferred stock, retained earnings, and subtracts any treasury shares. Once you have both numbers, you can perform the calculation. The formula is simple. Debt-to-equity ratio equals total liabilities divided by total shareholder equity. For example, imagine a company has $200 million in total liabilities and $100 million in shareholder equity. To find the debt-to-equity ratio, you would divide $200 million by $100 million, resulting in a ratio of 2. This means for every dollar of equity, the company has $2 in debt. Understanding this ratio is especially important in stock trading and options trading. A high debt-to-equity ratio may indicate that a company is heavily reliant on debt, which could increase its risk. On the other hand, a low ratio might suggest that the company is conservatively financed, indicating stability. Traders can use this information to identify overvalued or undervalued stocks. If a stock has a high debt-to-equity ratio, it might be seen as riskier, leading some investors to avoid it. Conversely, a low ratio could attract investors looking for stability, making it potentially undervalued. In summary, calculating the debt-to-equity ratio is straightforward. By understanding a company's financial structure, traders can make informed decisions about buying or selling options based on perceived risk and potential volatility. This metric is a valuable tool in the world of stock trading and options analysis.